In this video, I want to share with you a trade I made where I sold a covered call for NVIDIA stock symbol NVDA. Now NVIDIA is currently trading right around $180 per share. So for me to sell a covered call, I'd have to own 100 shares or roughly $18,000 worth of stock. But take a look at this covered call I just sold where I don't even own shares of NVIDIA stock. So before I give the details about how I was able to sell a covered call of NVIDIA without actually owning the stock, let me take a brief moment and mention my stock option trader user community. It's over at school.com/simpleoptiontrading. It's where option traders like you and I get together and share helpful tips, tricks, hints, and secrets about options trading. In this free user community, all of the members share information about trades they're doing, information related to stock option trading, and current helpful trends. There's also a classroom where I share helpful information like a Start Here course, a covered call mini course, and I also offer free downloads, including my beginner's covered call checklist and my cash secured put checklist. And if you join my free user community today, you'll become one of the founding members. So if you're interested in becoming part of a useful stock option trading community, be sure to utilize the link below, which I'll include in the description, for school.com/simpleoptiontrading. So my secret for selling a covered call with NVIDIA as the underlying security takes advantage of a leveraged ETF, NVDX, which is a derivative tied to NVIDIA. Now, if you're not familiar with a leveraged ETF or exchange traded fund, it's a financial instrument designed to amplify the daily returns of the underlying stock or asset. In this particular case, NVDX is a 2 times leverage of NVDA. And what does that mean to you and I? Think of it like this. If NVIDIA stock goes up 1%, then the 2 times leverage ETF, NVDX, will go up 2%. By that same token, if NVIDIA drops 1%, well then NVDX will drop 2%. So you see it's got that 2 times leverage. It does twice whatever the underlying security does. So there's 2 things I really like about this leveraged ETF. Number 1, it is a leveraged ETF, and the fact that it's 2 times can be a little scary or risky, right? So if the underlying goes up or down, then the leveraged ETF goes up or down, but twice as much. But not only twice the gains, but twice the dip. But as an option trader, I love the volatility because that eventually turns into higher premiums, which means more money in my pocket as long as I manage the risk. And the other thing I love about this exchange traded fund is the lower cost of entry. Remember, NVIDIA is trading right around $180 per share. But let's take a look at what the 2 times leverage ETF is trading for. Here we can see a daily chart for NVDX, the 2 times leverage ETF that's tied directly to NVIDIA. And the current share price is just over $18, which makes owning 100 shares so that I can sell a covered call contract a lot more affordable. In fact, it's 1/10 the cost. So rather than owning 100 shares of NVIDIA at $18,000, I can own 100 shares of this 2 times leverage ETF and still get the advantage of the NVIDIA market for only $1,800 for those 100 shares. Now, before I submit this order, let's go ahead and take a look at it and review the numbers to make sure that it makes sense from a profitability standpoint. All right, I'm considering selling a covered call option on today, August the 4th, for stock symbol NVDX. Now my cost basis is $17.14 per share. So I have 100 shares and my cost basis was $17.14 for each of those shares. Now with those 100 shares, that means I'm capable of selling 1 option contract. And for the expiration date, I'm going to use the August 15th expiration date. So we'll go ahead and put that in here. And we can see that the length of that contract is about 12 days, so just under 2 weeks. Now for the strike price, I'm going to be using $18 per share. And then for the premium amount, I'm looking at using 65 cents per share as the premium amount. So my total investment, which is the cost basis for my 100 shares, is $1,714. Now the price appreciation, let's say on the expiration date, the buyer decides to exercise the option contract and my shares will get assigned to the buyer. Well, then I'll receive $18 per share. Remember the strike price, $18. I'll receive $18 per share times my 100 shares. And then when you subtract out my total investment, well, then my profit just from the cost of the shares being different, right? So the share price went up. My profit from that would be $86. And that represents a 5% profitability just from the price appreciation. Now the premium amount, right, I specified 65 cents as the premium. So when the option contract gets filled, I would receive $65 as my premium payment, and that would be an additional 3.79% of profit. If we look at the total profit now on the expiration date, when the buyer decides to exercise the option contract, or if the buyer decides to exercise the option contract, I would receive payment for my shares, which would be at $18 per share. So that profit is $86, plus the original premium payment that I received. So that's the $65 up front, which would give me a total maximum profit potential of $151. And that's an 8.81% return off of my initial investment. So based off of these numbers, I think this option trade makes a lot of sense for me. Even if I get to keep my shares and my only cash profit is from the premium, it's still almost 4% for this 2-week trade. And the other upside is if the option contract expires worthless, I'll keep my shares and I'll sell another covered call. Now let's jump over to my smartphone and take a look at my trading application, where we can see I've got the ETF NVDX up on the screen, and this is the 2 times leverage ETF for NVIDIA, and I have 100 shares, so I want to submit an order to sell a covered call. So I'm going to go ahead and press trade and then trade options, and here we can see the different selections. I'm going to use the August 15th expiration date, and I'm interested in selling a covered call with a strike price of $18. So I've got August 15th selling a covered call, $18 strike price, and here are the details behind that particular option contract. You can see the delta is high at 0.4, but I'm actually okay and willing to sell my shares if they get assigned on or before the expiration date. There's plenty of interest in this option contract, although the spread between the bid and ask is a little bit high, but I've calculated my ask to be right around 75 cents per share. So let's go ahead and continue. So I'm going to specify to sell one option contract using my 100 shares of NVDX, and my limit price is going to be 75 cents per share. Now, when we review the order, we can see that I'm willing to sell 100 shares of NVDX at $18 per share. That's my strike price on or before August 15th, which is the expiration date. Now, if at the expiration date on or before the buyer decides to exercise the option contract, then I'll be forced to sell my shares at $18 per share, which is fine. I'm okay with that. So I'm going to go ahead and submit my order. My order is received and placed. All right, here's the receipt for my transaction. You can see that I placed the order to sell a covered call, a stock symbol NVDX, with an $18 strike price and an expiration date of August the 15th. Now, I submitted this order on Friday, August the 1st, after the close of the market, but it actually got filled on August the 4th at 6:30 a.m. Pacific time when the market opened. Now, when the order got filled, I sold one contract and received 65 cents per share as the premium price, which gave me a total premium payment of $65. So let me just make a quick note here, because sometimes I get asked about this, whether or not that premium payment I've received is mine to keep, and also is it treated as taxable income. Now keep in mind, I'm not a tax lawyer, I'm not an accountant. I'll tell you what I'm doing and how I'm treating this. You need to check with your tax accountant or your professional financial advisor to give you suggestions and recommendations on how to treat it for yourself. But for me, that $65, that's treated as ordinary income, and that's my profit to keep forever and ever, no matter what happens with the contract. Whether the option contract gets exercised and my shares get assigned, or the option contract expires worthless, that $65 is an income to me, and I'm going to take 25% of it, or $16.25, and I'm going to set that aside immediately, and save it so that I can pay my taxes on this profit that I just received. If there's enough interest, I'll make another video how I'm able to take that money that I set aside and collect dividend income, so that by the time the end of the year rolls around, not only have I saved up 25% of all the profit I've received, but I've also generated an income in the form of dividend payments over that year time frame. Now, on the surface, the tax payment for a $65 premium doesn't seem like a huge burden. But let me tell you from experience, these add up over time. As you're collecting $25, $50, $100 every week from your option trades, by the end of the year, you've created a significant income. And so you always want to plan ahead and make sure you set some of your profits aside so that you can pay your taxes. If you like the information in this video, I'd like to invite you to join my free user community of stock option traders just like you and I. You can find it over at school.com/simpleoptiontrading. I'll leave a link in the description down below. I hope to see you there, and I hope to see you in the next video.